We've got a packed show for you, with all the latest news and analysis from the world of stocks and finance. To start us off, let's take a look at the ongoing situation between the US and Europe, where tensions are rising over President Trump's threat to impose tariffs on several European countries if they don't agree to sell Greenland to the United States. This move has sent shockwaves through global markets, with investors scrambling to make sense of what this could mean for international trade and economic stability. As we delve into the details, it becomes clear that this isn't just about a potential land deal, it's also about the broader implications for geopolitical relationships and how countries navigate complex issues like sovereignty and economic interests. The European Union has already warned that they may activate a package of counter-tariffs if the US follows through on its threat, which could lead to further escalation and potentially significant impacts on global trade. In response to these developments, we're seeing investors flock to safe haven assets like gold and silver, which have both hit record highs. Gold jumped 2% to a record $4,688 per ounce, while silver spiked 4% to an all-time high of $94.02 per ounce. This surge reflects not just the immediate reaction to Trump's threats, but also a deeper reevaluation of risk within global portfolios and a growing lack of confidence in fiat currencies. It's essential to consider multiple perspectives on this issue, from the potential economic consequences to the geopolitical maneuvers at play. As we continue to monitor these developments, it will be crucial to separate speculation from fact and to understand the diverse viewpoints of stakeholders involved. We'll be keeping a close eye on how this situation unfolds and what it might mean for investors and the global economy. For now, it's clear that uncertainty is driving market decisions, and safe haven assets are seeing significant gains as a result. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're diving into the world of central banking and politics, where the lines between independence and influence are often blurred. Today, we're examining the intriguing situation surrounding Federal Reserve Chairman Jerome Powell and his potential plans after his term as chair expires in May. It's a tale of power dynamics, with President Trump seeking to shape the Fed's monetary policy to suit his administration's goals. The president has been vocal about his dissatisfaction with the current state of interest rates and has made no secret of his desire to have a more compliant Fed. But will Powell, who has been a target of Trump's criticism, opt to stay on as a governor after his term as chair ends? Some experts think so, citing historical precedent and the potential for Powell to counterbalance Trump's influence. We've seen this play out before, notably in the 1940s when Mariner Eccles, then Fed chairman, stayed on as a governor after being removed by President Harry Truman. It's a bold move that could allow Powell to continue shaping monetary policy and pushing back against any attempts to undermine the Fed's independence. But what about the odds? Prediction markets are betting that Powell will leave, with Kalshi currently giving it a 70% chance. And while traders may be skeptical, some on Wall Street believe that the threats to Fed independence could actually encourage Powell to stay put. As market veteran Ed Yardeni notes, Trump's push for Fed compliance ironically may lead to more Fed independence. It's a counterintuitive outcome where the president's efforts to exert control over the Fed might ultimately backfire and strengthen the central bank's resolve to maintain its independence. So, what does this mean for investors and the broader economy? For one, it highlights the ongoing tug-of-war between politics and monetary policy. As we navigate these uncharted waters, it's essential to stay informed and adapt to the evolving landscape. Welcome back to the Riskwiser Zone. Today, we've been exploring the complex world of mortgage rates and their impact on the housing market. As we wrap up this episode, let's take a closer look at what's in store for potential home buyers and refinancers in the coming months. Mortgage rates have been a hot topic of discussion lately, with some experts predicting they'll remain stagnant throughout 2026, while others foresee a potential dip. The Mortgage Bankers Association predicts the 30-year fixed rate will stay at 6.4% throughout 2026, whereas Fannie Mae's forecast puts it at 5.9% by the end of 2026. It's essential to remember that these predictions are subject to change and may be influenced by various economic factors. As a homeowner or potential buyer, it's crucial to stay informed and adapt to the shifting landscape. We've also discussed the concept of rate buydowns, which can provide temporary relief from higher interest rates. Additionally, exploring alternative options like 15-year mortgages or condominiums might be worth considering for those looking to enter the market. It's also important to put current mortgage rates into historical perspective. While 7% may seem high compared to recent years, it's relatively moderate when looking at the broader context of mortgage rate history. As we navigate the ever-changing world of mortgage rates and housing markets, it's vital to approach each decision with caution and careful consideration. Whether you're a seasoned investor or a first-time buyer, it's essential to weigh your options and seek professional advice when needed. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.